Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Well, welcome everybody. We're excited to be with you this afternoon for our monthly AWA Market Minute. As I kind of lay out the topic for today, I wanted to share a quick story. A couple of weeks ago, and you guys probably can't see this anymore because it's healing up nicely, but a couple of weeks ago, I was playing pickleball. Now, I get some serious flack from my team on the fact that I like to play pickleball. Many of you hopefully have played and enjoyed it as well. But I'm in the middle of a pretty heated match point, and the opponent slams the ball pretty hard, pretty fast right at me. Now, the ball was high and quick, which means had I just calmed down, slowed down, stepped aside, it would have sailed out of bounds, no problem at all. But in the heat of the moment, in the emotion of the moment, I kind of overreacted, actually. I took my paddle and I kind of threw my paddle up in front of my face. I stepped in front of the ball, and I missed the ball, but my paddle struck my nose, the bridge of my nose here. And so let's see here. I got a picture of it. There it is. Okay, so there's a picture of my nose, and that's actually a pretty good-looking photo. It felt much worse than that. My nose split open, blood gushing everywhere, all over the court. I talked to my friend who was there, who's a doctor, and he looked at it, and he said, "Yeah, you'll probably want stitches." What we determined was, regardless of how we treated it, I was likely going to end up with a pretty gnarly scar on my nose. So we opted for the super glue route, and I ended up finishing the game. So the reason I spend a minute talking about this is because this was clearly an overreaction to the situation, right? I could have simply slowed down, stepped aside, and let the ball sail out of bounds and let the point play out as it could have or should have. But instead, I overreacted, and as a result, I smashed my nose open. So I wanted to tell everybody, a funny story about how I smashed my nose by saving a kid from a burning building, or got into a bar fight or something cool. The reality was far less cool than either of those stories because it was a self-inflicted wound. And when I tell people that I hit myself in the nose with a pickleball paddle, they kind of give you one of those looks like, really? Not a very cool story. Yeah, self-inflicted wounds are kind of the worst. And today, we're going to talk about the self-inflicted wounds that we can occasionally experience when we look at this market volatility. We've recently had market volatility reintroduced, and there's a kind of a primal reaction that many people experience as we see market volatility, especially when we've experienced several years of market euphoria. And there's a primal reaction where we say, we got to do something about this. We have to react. We have to do something about this. And more often than not, our attempt to take control of the situation and act turns out being an overreaction, not an appropriate reaction. So today we're going to talk about how to really have a good grasp on what's going on out there in the market and what are some appropriate steps and strategies that we want to make sure we're employing to not overreact, but react appropriately. All right, so Jaron, would you mind talking us through this slide?
Yeah, definitely. So just for some context, year to date, the market's, the S&P 500 is down just over 9%. So that gives a little bit of context to this graph here. And what would be nice is if you could actually block off the top portion of this, you don't see any of those bars, and just look at all those negative points on that plot. Now you could probably attach a bunch of different news stories and everything else to all these negative years and all these different events that are happening across the world. But if you look across all of these years, starting from 1980, so we're covering quite a few decades here.
42 years.
Yeah, 42 years. The annual drop of 14%, that's the average across all those years. So even in all these years where you have these large gains, you'll still see all of this volatility in the market. If you look at like 2008, it's the lowest bar that there on the between 05 and 010 there, or 2010, you'll see a low point of a negative 49% drawdown. And then in the following year, a negative 28%. But if you look on the flip side of that, there is a 23% gain in the market. So it's critical through all those different years when you see an average drawdown happening that you kind of stick through that course, because on the flip side of that, the market is going to have those gains coming throughout all those years, but there's going to be an average drawdown of about 14%.
Jaron, one thing I love about this chart is if you were to survey the population and say how often the market's up, and they'd probably think it was a coin flip, right? Like maybe half of the time, maybe 60% of the time.
Mm-hmm.
No, in this instance, I mean, it's 34 years or whatever out of 42 where the market's up.
Mm-hmm.
So I'll take those odds all day long. I mean, the deck is definitely stacked in the favor of having markets up, but to be able to to have those gains, you have to stomach the intra-year 14% loss.
Yeah, in fact, last year, I believe it was like the second largest year on record for the most all-time highs in the market. I think there were 69 all-time highs. So a lot of people probably think, at 30, the market's got to go down at that point. So there's always a flip side to that, right?
And in '09 is a great example of just, when we endure an average intra-year drop, and just for maybe a little better understanding, when we say intra-year drop, we don't mean where the market closes that year. We're talking about some point during that calendar year, the market does drop. On average, 14% per year. So at some point during any given year, we are already planning on a 14% intra-year drop. That is normal. That is common. That is expected behavior. And if we want to experience 32 of 42 years in the market that are positive, we have to be willing and able to say when that market drops 14%, I'm not going to overreact. I'm not going to do anything, because in 2009, the market lost 28% intra-year, ended the year with a 23% positive gain. You had to be able to endure a 28% drop to make up all those losses and then recoup up to a 23% gain. Yesterday alone, the Dow was down at the low of 1,000 points yesterday. So if we had an emotional reaction yesterday and said, that's it, I'm cutting ties with the Dow, and sell out at 1,000-point loss, we would have missed out on where the Dow recouped all those losses by the end of the trading day and actually turned green, right? So just not being emotional, because this is actually expected volatility. Mace, do you want to walk us through this next slide?
Yeah. Let's go back a little bit further. That last chart was back to 1980. So let's go further. So if we look back to pre-1930 Great Depression time period and look at a bunch of different events. Now, this isn't all the events that have taken place over that time period, but look at a bunch of significant events that have happened in history, and which one of these events would have scared us out of making a good investment.
One thing that I think is super interesting about this chart and this discussion generally is late 1970s, early 1980s, people were, pretty depressed as far as kind of the market outlook and economic outlook. The Soviet Union was ascendant, inflation was high, energy costs were high. A lot of people thought the United States had its day in the sun. And on the back of that, we had 40 years of prosperity. So, to feel like, hey, these times are, the first time we've had major difficulty, that obviously isn't the case. We've had many instances of difficulty as a country and as a world, and through it all, those who persisted with investing have done really well.
And I think another, point for me, a takeaway for me, is how many of these events would have triggered me to say, that's the end, right? I'm done investing. And if you go back and look at some of these events, I think there's a significant amount that you would have thought the sky was falling, the world was ending as that event was taking place. Now, some were, totally fabricated, like Y2K, right? Came and went, nothing actually took place. But there was a real fear that built up to that moment, and people were reacting poorly from that fear. So I think the takeaway here is what are we going to do during these moments of volatility? And are we going to overreact like I did and during pickleball and smash my nose with the paddle? Or are we going to react appropriately, calm down, let the point play out the way it's supposed to play out, and actually be just fine? So you want to click on the slide, Andrew? You got it. There you go. So let's talk about a cool illustration that Charles Schwab built a few years ago called When Markets Dip, and their suggestion is don't drop out. Now, they point out three actors in this slide. There's a stalwart, there's a reactor, and there's a waffler. Now, each of these investors saved the same amount of money annually, and they had the identical starting allocations. Okay, but they all ended in three very, very different places at the end of their retirement journey as far as the amount of money they had actually accumulated. So what made the difference was their behavior. Let's talk about behavior here. The first behavior we're going to look at is the waffler. Now, the waffler, every time the market goes into a corrective cycle, right, the waffler says, I want to sell and buy back in again, sell and buy back in again. Every time I see the market going down, his goal is to say, I want to sell it. And then when I see the market going back up again, I want to buy back in. As a result, the waffler ends up with about $615,000 at the end of his retirement journey. Okay. The next investor we're going to look at is called the reactor. Now, the reactor isn't moved nearly as quickly as the waffler is. He's actually much more steady, but he pulls the fire alarm during major market problems, like in 2008 when the market sold off significantly. The reactor said, that's enough of this exercise. I'm done. And puts his money back into fixed income, never to be back invested again, ends his investments with about $485,000. Now, the third and final investor is named the stalwart. And the stalwart investor simply knows his speed limit, sets cruise control, and stays in his lane, right? Know your speed limit, set cruise control, and stay in your lane. And as a result of this, the stalwart turns off the news. Not to say he's not aware of what's going on out there. We're going to talk about that in a moment, what's actually going on out there. We're not suggesting not to be aware or naive or ignorant. That's not the goal here. It's just to not get emotional about those things, because investing is not an emotional exercise. It's a long-term planning exercise. And the stalwart says, hey, as a result of not being emotional, he ended up with $1.1 million in his investment portfolio, nearly double what the waffler did, nearly triple what the reactor did. So the goal here is to say, we don't want to overreact here. So to your question, what are we doing? What do we need to be aware of as far as the markets today, the economy today? So let's touch on our 2022 outlook.
Yeah. No, great segue, Paul. So as an investment committee, one thing we do on an annual basis is we go through an exercise to kind of develop a thesis for the upcoming year. And so we sat down as an investment committee kind of December or January and formulated our thesis about this year. So there's 5 themes that we kind of identified, and we can spend a minute on each one as far as what we think will be things to really watch and the things that are going to really move the market. And then on the back of that, we'll have some suggestions or kind of a playbook, if you will, as far as how to respond to these trends and kind of opportunities throughout the year. First one, and I'll take it, is inflation. Inflation kind of remains, you can't open any kind of publication, financial or otherwise, without seeing inflation. And inflation isn't on its way. Inflation is very much here. And the question is how long it's going to persist and how steep inflation will be. And we've seen a pretty significant shift with inflation this year as far as how the Federal Reserve has responded. Last year, they were pretty cavalier about it. They talked about inflation being transitory in nature, which suggests it's going to be a temporary kind of COVID-related phenomenon. And our thesis is that's not the case. There's a component of our inflation due to supply chain issues and COVID, and that part will eventually diminish and go away over time. But a lot of the inflation, in our collective opinion, is being driven by easy money policies that the Fed has been facilitating. Fast forward to this year, and the Federal Reserve has gotten religion. They have started to suggest that interest rate rises are imminent, perhaps 3 to 4 over the course of the year, and that has spooked markets. This is probably the biggest driver of the volatility that we've seen as of late is inflation concerns.
Yeah, and so it's interesting because a lot of people are trying to figure out, put the finger on the pulse, why the market is reacting the way it is, and I think that's probably the biggest, driving force is consumers worry about these inflationary pressures, and then the Fed responding with significant, fiscal policy that would potentially say, hey, some of these tech stocks we've been valuing based on low interest rates, multiples of earnings projected out 2 and 3 years from now, we're going to have to revalue those based on a raising interest rate. And so you see stocks, indices like the NASDAQ really, get some scare involved.
Yeah, and it's not all bad as far as what the Fed's doing. I mean, we're seeing a negative effect in the markets, to be sure, and none of us are happy about that. But in some ways, having a more responsible monetary policy, super beneficial for our economy in the long run.
We're taking our medicine.
Yeah. And I joke that in some ways, this almost feels like a sacrificial year for monetary policy, where it's, hey, we're going to sacrifice, maybe a little bit of economic growth at the altar of, inflation, if you will. In the spirit of future years, we're going to see better, monetary integrity and better prospects for future growth.
Yes, yeah, totally agree. And the other one that we look at is geopolitical risk.
Yeah, so from a geopolitical standpoint, you've got events happening between countries all over the world. The main three would probably be, you hear in the news about Russia and Ukraine, this whole border crisis that's happening there. You've got Israel and Iran with the nuclear program, and then you've got China and Taiwan. Probably the biggest thing to keep in mind with any of these, and in past events like these, is they initially create a shock wave that hits the market. Either anything that's really happening on a global scale is going to affect the U.S., vice versa.
Markets like stability.
Yeah, they
and
do.
That causes anxiety.
Yeah, the thing that they hate the most is uncertainty.
Yes.
Markets hate uncertainty. And so anytime there are some variables that are just unknowns, and people don't know what's going to happen in these events, that's what creates these initial shocks to the market. But over time, the biggest takeaway is, if you look at a long time horizon with these events, these geopolitical turmoils, they eventually stabilize and things actually start going up in the market. So we recognize that there are things happening in the world that can create these shock waves, but the big takeaway is that they eventually will stabilize over time.
Good.
And maybe just to add to that, Jaron, so we often see, hey, with Russia and Ukraine, for example, if tanks roll into Ukraine, next week, there's going to be probably a visceral reaction. The market will probably sell, and then there will be some actual calmer heads that prevail, and they'll look and they'll say, hey, is this a ring-fenced situation where it's probably not going to spread much further and it's probably going to be fairly localized, and then markets recover. If China, on the other hand, invades Taiwan, that's something that's going to be much more impactful to supply chains and economic policy and everything else. And that one would be, more severe impact and longer in the tooth. So each of these is kind of individualized, but your point's absolutely right that there's going to be an initial shock, and then often calmer heads prevail and markets recover.
Mm-hmm. And one of the questions being asked, or maybe a point being made is uncertainty and turmoil is still kind of building. There's still pressure mounting there, and no, we're not heading towards stability. And we're not trying to, say that we have a crystal ball as far as when stability will be reintroduced in the world. I think our point is, yes, we understand and agree that there is pressure building in this geopolitical arena, but to Mason's earliest slide, that's kind of always been the norm. Yeah. We will always experience these big events that have taken place over the last 80 years. We've seen these events taking place. And so, steady at the wheel, steady at the helm. That's kind of the goal here, is to not overreact over these geopolitical events, but to react appropriately, not, in a state of fear or panic. The other one that we still see is COVID, right? We know that COVID has created a significant disruption in our supply chain with employment and even the psychology of how we're kind of interacting as a society has been turned on its head. And so we know that that's not gone away. There are a lot of people that are saying it's reached endemic stages now and that we have to learn to just live with it. There are others who say we're mid-pandemic and we have to figure out how to fight and eradicate it. And there's still some uncertainty around COVID. It's yet to play itself out.
Yeah, and I think with that backdrop, I think we do feel like maybe from an economic standpoint, the impact is going to be ever diminishing, right? The impact we see today is less than it was a year ago at this time. Certainly less than it was 2 years ago, and we think that will continue to kind of diminish over time.
Yeah, totally agree.
The next risk that we've discussed quite a bit, and we've talked about this last year as we've done market minutes, is just legislative risk. We've heard of different legislation wanting to be passed, and different ideas have been floated out there. And over the last year, there's been a few congressional holdouts, that have made it so that legislation hasn't been passed. But of course, at any point in time, that's one thing that we don't control, is legislation can be passed, and it can be passed in different areas. And so that's, of course, always at the top of our list of things to watch and be concerned about, is how that can impact the markets overall. Now, one of the interesting things, and we've talked about this previously, but one of the interesting things is that when we look at historical data and where the markets have been, when we have gridlock in Washington, it's actually positive. It's been a positive thing for the markets. So some of the best economic time periods is when we have gridlock.
Because again, markets like stability, predictability, continuity, and major disruption just causes the markets to, not know how to forecast what to do.
Yep.
And the interesting thing, right, is we could see a prolonged period of gridlock. If this impasse remains through 2022, we'll have an impasse in 2022. And then if there's a changing of the guard in Congress, we could potentially see gridlock for a longer period of time. So as you mentioned, that tends to be a tailwind for markets when there is political gridlock.
Yeah.
In the few minutes we've got left, let's talk a little bit about kind of our playbook now. So what is it that we are doing and kind of seeing and trying to, what is our appropriate response to some of this turmoil that we're seeing out there?
I'll share a few, Paul. And as we kind of dive into this, keep in mind this is just general information. It's not intended to be specific to your situation. We do want to review these things with you individually, but here's some general themes that I think can be taken advantage of. On the back of the legislative discussion, there's probably a bit of a green light to realize capital gains. Last year, there was a lot of fear. Do I realize some big capital gains? Am I going to have a kind of bait and switch where I realize my capital gains and then have a higher tax rate? It's looking, knock on wood, like we could have some stability with tax policy. And in such case, capital gains are on sale. Not a bad idea to realize some of those.
Yeah, I love that. In that same vein, when we talk about taking advantage of market volatility for capital gains, tax loss harvesting as well.
Yeah.
Right? Having the ability to go through and say, how do I realize some of my losses on intentionally so that I can bank those losses, satisfy wash sale rules, buy back the holdings that I want to own in my portfolio, but then have those losses on my tax books for future realized gains so that the next time we want to go buy a car or whatever withdrawal we need to take out of our investments and sell our positions, we've already realized some significant losses to allow for us to not have to pay taxes in the future on earnings and gains. So there's an opportunity there when we see some volatility introduced to kind of sit down and say, okay, where are some places I can trim back and realize some losses?
Yeah, and in conjunction with that, Roth conversions. When we have market pullbacks, we have an opportunity to do some Roth conversions and be strategic about how much we're realizing in tax liability from a Roth conversion.
I mean, these things all help me kind of gain confidence, right? We're talking about like the psychology of investing and how it's a long-term investment. And we're talking about saying, how do we view this economic uncertainty in a light that allows for us to not overreact? And it really comes down to gaining confidence. And that comes with, planning and tools. And when we have the planning like smart retirement, where we manage cash flows for retirees through using protected buckets and defensive buckets and growth buckets, then that gives me confidence during periods of market volatility because I say, hey, I've planned for cash flows during retirement, and effectively, when we look at managing those cash flows, it gives you some confidence, right? And then tax loss harvesting, Roth conversions, I look at that and gain some confidence with that as well.
Yeah, and another big one would be back to like the whole geopolitical thing and just these leaders of other countries. Everyone's responded differently to COVID, whether it's shutdowns or quarantines, whatever that may be. The U.S. has been very hot as far as the stock market, and it's been at this all-time high. But you've got a lot of other countries that have or have not responded as well to those situations. And right now, I feel like international is going to have its time to shine, right? So different sections of the market come in cycles. So I think international will have a few more opportunities coming down the pipeline. So it's something that we would keep our eye on.
Yeah,
for specific purposes in each client's portfolio, right? So
absolutely. There's definitely space. I mean, in a 2-horse race in the long run, we like U.S. markets vis-a-vis international markets. But that being said, international markets have a lot of comparative value relative to U.S. markets. And so we feel like, well, that shouldn't be a big portion of your portfolio, definitely on the margins makes sense to have some there. Another thing we're looking at closely is the importance of owning quality. And by quality, we mean companies with strong balance sheets, low liabilities relative to their asset levels, strong cash flows. Those are the ones that weather difficulty really well. And with the Polands and the Dearborns and the other strategies that we employ, the common theme with them is strong, well-run companies, not indulging in a lot of speculation as far as companies go. And right now, we're in an interesting spot with the S&P 500, where last year the top 5 stocks generated a disproportionate amount of the gain. So we're super top heavy. And then the bottom fifth of the S&P is garbage, for lack of a better word. I mean, there's gremlins in the basement, so to speak, where you've got the bottom 20% of companies where if they can't roll over their debt in capital markets, they can't pay their debt payments. They're not generating enough earnings to service their debt.
We call these zombie companies, right? Where a company's debt servicing exceeds their earnings. And if a debt service exceeds their earnings, the only way they're surviving is borrowing more debt. And this is probably a really good kind of point for smart investing, right? Where rather than just saying own an index and just have everything just kind of saying we'll buy the entire market 6 times, 8 times, 10 times, really being intentional and deliberate about what you're going to own and why you're going to own it. And through our smart investing principles, really looking at the portfolio and saying, I really want to own certain companies based on the balance sheet, based on the quality of that company. And as we look at volatility, we have to change the psychology to say, look, if I own Home Depot and Microsoft, I haven't lost anything while the valuation of these companies is changing on a day-to-day basis unless I overreact, panic, and sell my Microsoft. If I haven't done that, and I've been able to manage cash flows through smart retirement, so I've got buckets of money where I can access cash, I can allow my red growth money to run, let it grow. Microsoft will be around for a long time. There's a lot of capital there, and they're not hurting from a balance sheet perspective. So we're not going to panic over the changing value of Microsoft on a daily basis. We recognize that there's an opportunity there through smart investing to pick the winners, good quality companies, keep them in your portfolio, and have confidence in knowing you've got really quality companies that you own.
Yeah. And one thing along those lines as well is this is a good time to be opportunistic, where some of those companies are down in value, where we can buy them at a cheaper price. So if there's excess cash in the bank, you just have extra money, dry powder is what we call it. Good time to throw it in, and
dollar cost average your way down.
Yeah, exactly.
And then back up again.
Yep.
Yeah. Dry powder brings jet fuel to the party.
Totally.
Yeah. Well, I think there's some really good takeaways here. If anybody has any questions before we wrap up, feel free to ask now. We'll take a minute for Q&A if anybody has any additional questions. There have been some questions kind of regarding our overall sentiment to the market. I think we've addressed those well. And I think the takeaway that we want our clients to have right now is the market on an average year will drop 14% intra-year. That is to be expected. That is the norm. And so we don't want to create an overreaction to this current market sell-off. We don't want to create an overreaction. Now, we're not suggesting that things won't continue to go a direction that we're not happy with. We don't know that. We don't have a crystal ball. What we do know is steady at the helm. Investing is a long-term exercise. It is not a short-term exercise. We are not buying something to try to sell it back tomorrow. We're trying to buy good quality assets and protect our retired clients using smart retirement principles to manage cash flows, to not have to sell something in a down period to finance our next vacation or car. And that's the concept we want you to walk away with here is you guys have smart investing and smart retirement, and those things are going to allow you to take confidence even during periods of market volatility. Any final parting thoughts, guys?
No, I think you've summarized it well.
Yeah. Very good. Well, we sure appreciate you guys all taking a minute to jump on with us this afternoon. And hopefully this was helpful. And don't hesitate if you've got additional questions, reach out to your team here at Alliance Wealth. That's what we're here for. So thanks so much, you guys. Have a great afternoon.